you plan to take it ahead with the government also, because the appointments are to be made by the government and the composition is always lacking at the PSU level, and every year notices are sent by the stock exchanges. Every year they make an application that please waive off this penalty that is being imposed. Is this going to continue? How do you plan to address it?
So, as you would have seen over the years, SEBI has evolved a set of regulations which we call risk-based regulations, right? And those recognize the risk of each issue that we deal with, and we know that there's a gradient. We also deal with what is the ground reality of every segment of the market. So let's say, for instance, when we permitted loss-making entities to IPO, right? Now, there is a very different set of risks and a very different set of ground realities for those entities. Similarly, when we had SMEs, right? So we have an SME board, as you know, and their constraints are very different from everybody else. So I think the important thing that we recognize is that one size fits all can make regulation very constraining. And that's not a good idea. We now have the technology to be able to monitor on a segmented basis. So even, for instance, in the area of REITs and InvITs, we have advised the entire industry that if they want to come back and ask for segmented regulation, because each subsector is large enough to warrant a separate subsector regulation, we are quite open to that. So the question is that I don't think it is necessary for us to have a one-size-fits-all. It used to be the case when I would say the regulator needed to simplify its own life to monitor things, keep it simple. But that's not a requirement now. We have technology available to us and we can do it across the board. See, if marketing professionals are now talking of a market of one, okay? If readership of the media is talking about small communities, homogeneous communities, why should the regulator not respond by saying that we will have horses for courses and that we have, it's the confidence we have that we can monitor now using technology. So we don't worry about it. I'm saying for us, we look at different subsegments differently. We see the risks differently. Our response is different for each subsegment. Thanks.
Ma'am, may I, since you mentioned SMEs, and I think there's a fair amount of chatter around it, great initiative, and we've seen huge listings, but we've also seen listings with 100 to 200% gain on a day. So I think the chatter that we keep hearing is that whether at least some sections of SME, there seems to be a bit of a wild west in the making over there, and whether there's need for greater oversight, maybe slightly tighter regulatory norms as well. Your thoughts?
So I would say that the feedback to us from the market is very consistent with what you are saying, that while the desire of the regulator was to be facilitative and to have a listing environment which is not as, I would say, as well regulated as the main board, because small and medium enterprises find it hard to comply with many of those requirements. The objective was appropriate. Are there some entities which are perhaps misusing that facilitative framework? We have received feedback that that is the case. The first step we took, as you know, was many of the surveillance measures like ASM, GSM, which earlier were not applicable on the SME board, have been made applicable there. And the principal objective of that is really to try and mitigate the risk of price manipulation. Having said that, the reality is that these are relatively small entities. The market cap is small, the free float is small. It is relatively easy to manipulate both at the IPO level and at the trading level. So is there something more that needs to be done? I think as a first step, we are clear that some more disclosure in terms of risk factors. So for investors to understand that the SME segment is different from the main board, the regulations are different, the disclosures are different, and therefore the nature of the risk is different. I think it's important for SEBI to underline that in terms of disclosures to the investors. The second is in terms of actual price manipulation, both at the IPO level and at the trading level. We are working, to, I would say, to evidence that we do see the signs. We, as I've mentioned earlier in a press meet, that we have the technology to do it, so we are able to see certain patterns. However, as per our regulation, the way that we need to construct the entire case, we do need to take some time to do that in a robust manner. Fortunately, the market has given us the feedback and advised us on what we can do in order to identify such cases and to deal with them. So I would say we're really quite grateful. The industry is behaving in a very mature manner and assisting us in doing this, because we're all aligned on the main objective. If there is anything which a few isolated cases or a few cases which go bad will detract from the trust of the whole ecosystem. Now, nobody wants that to happen. So I think that going forward, with the assistance of the industry itself, we should be able to mitigate some of the risks which are inherent in this segment.
Ma'am, you mentioned some additional disclosures that could help investors make better assessment of the issue. So is there a time frame by which you sort of will put in certain, fresh guardrails?
So it's still, I would say, it's still on the kitchen table. It's not yet gone into the oven. You know that when we issue a public consultation paper is when it enters the oven. But right now it's still on the kitchen table. We're still working with advisors to try and understand the dimensions, the data, analyze the data. So still at a relatively early stage.
What kind of disclosures that you're hoping SME IPOs will bring on?
Still on the kitchen table. Once it enters the oven.
Disclosures at the time of the IPO, or are you looking for some other kind of
both.
subscription disclosure?
Both. As I said that the malpractices that we have been alerted to by the industry are both at the IPO stage and at the subsequent trading stage. In terms of at the trading stage, many of you would be aware that already a number of the large brokers have a what we call point of trade alert for investors, right? So if you are buying if you put in a particular stock code, ISIN or a code, it actually pops up at you and says that this particular stock is under surveillance measures, right? So it gives the investor a warning to say, this is already under surveillance, do you really want to proceed or not? And then the investor, if he says yes or no, but he has been given that piece of critical information at the point of trade. Now, we think that there's a lot of opportunity to enhance the quantum and quality of this input which is being given to the investor at that point in time. So it's very relevant. It's not a generic, sort of a disclosure where somebody has to go somewhere to look for it. It's at the point in time when they are looking to buy a particular script, they should get relevant inputs which are completely objective. There can be no opinion about this information that pops up at them, but whatever is the relevant data should pop up at them. So in terms of the secondary market trading, we are looking at strengthening this pop-up to investors. On the primary market, we are still, as I said, it's still on the kitchen table. We will need to do some more analysis before we can crystallize our thoughts on it.
So any action that you take, it will be on the SMEs or it will be on the
Sorry, I didn't understand the question.
The action that you intend to take on this, is it on the SMEs or any of the investment bankers or the brokers or those involved?
No, it depends. Whatever is the role played by each individual, we don't set out with any preconceived notions. We examine a case and see what has really gone on. And based on what emerges, we either take action or strengthen policy or do whatever we need to. So we always have a regulatory response, which is a combination of wherever enforcement action is required, we'll do that. Wherever policy intervention is required, we will do that. So
are there any
both.
points, ma'am, on which the exchanges can be held accountable for any of this?
exchanges?
Because
Mahalakshmi,
in the
any
end-
thought? I'm not
No,
able
I'm
to.
saying that because all of these papers, etc., IPO filings, prospectus, everything is passed by the exchanges. So the diligence that is done is not SEBI, right? So
Right.
so can they be held accountable for any lapses?
So, so a very valid point. As you know, across the board, SEBI is now doing automated supervision on a 100% basis, no sample, 100% basis supervision. Now, wherever the supervision is requires analysis of a structured nature, right? It's very easy to write the algo and to implement it, and we've rolled out across many intermediaries now where we ingest the data, we run the algos, we find whether something has gone wrong or not. In the case of analysis of documents, right now the process is manual. We have undertaken a sort of a, what shall I say, a thematic inspection to look at whether the exchanges have appropriately ensured that appropriate disclosures are made for the SME listings as well. Because ultimately that's what's important, appropriate disclosure, right? We don't stop anything anytime, we ensure that there's adequate disclosure. So in a manual sort of a way, that process is on. It's part of our inspection of the exchanges. So there is a thematic review of this going on. But I think the real impact of this will come when we are able to use artificial intelligence. And the reason we can do it quite simply and quickly is, A, these are all public documents. So, you know, it's a little more challenging when you have to use AI for confidential data and documents, because it's not easy to deploy. But since these are all public documents, A, it's very easy. B, we now have the skill set within SEBI to actually use this technology. So we are hoping that we will be able to do that ourselves. And once we've been able to demonstrate that, we will work along with the exchanges that if SEBI can do it, so can the exchanges. So instead of SEBI showing up later on and saying this disclosure was inadequate, the exchanges themselves should use technology now in a much more intelligent way, and at the time of the filing itself identify if there are any gaps in the filings. So I think it's a matter of months, and certainly not years, when the quality of examination of the documents should improve very significantly.
Okay. Two questions.
No, we won't comment on any specific.
Last time we met right in this very building, you had said that you was investigating more than one instance of violation of regulations when it came to IPOs, debt and equity market. Issued one order. Are we to understand from the details of that order that this is a fairly widespread practice and that many other entities are under investigation?
I won't comment on that. It's, I think it would be inappropriate to comment. We always articulate, what is it that we see as a regulator happening as a trend, which I articulated last time. But it would be inappropriate to comment on specific investigations, specific orders.
Action was coordinated in some ways because you all shared information with the RBI. The RBI notice against that particular entity indicates that a variety of entities are under investigation in that very same matter. So I'm therefore asking if,
Nanika, we won't be able to talk about specific cases.
comment on the collaboration with RBI. And I know this has happened before, but it doesn't seem to have been to this detail in the past.
So,
if you all are working far more closely together.
So, here's the thing. There is, I think, what is being presented as a coordinated, what word would you use, Menika? No, collaboration. No, as though there is this coordinated effort to do something. It is not so. What it is that the financial sector regulators, and it is not just SEBI and RBI, it is SEBI, RBI, IRDA, pension fund regulator, all of us, and NAFRA, IBBI. So with a lot of the financial sector regulators, we work continuously and we have a lot of exchange of information. Now, wherever there is, and this is a standard practice, it has been followed in the past, continues to be followed. Perhaps what we have now is a lot more specific data and specific consolidated data, okay? As I said, because now when we do supervision, we have the benefit of 100% data, not just sample data. So the benefit of that data and then saying that, look, we are examining something from our perspective, from the securities law perspective. However, it appears that there may be some relevance to what comes under your jurisdiction. We send that information and that data to the relevant regulator. And that regulator independently takes that action. It may be a coincidence that something comes within days of each other, but we have really no idea, because these are enforcement actions which the regulator does not, there is no coordinated effort saying, okay, you issue your order today, I'll issue my order tomorrow. It doesn't happen like that. So information sharing happens in both directions, and then each organization, each regulator takes its own view. If it happens to come within a few days of each other, that is just, I think, a reflection of the fact that there is adequate data in the hands of both regulators to take action, and that both of them consider it important enough to act quickly. It's a reflection of that. Beyond that, it's really a coincidence. There is no coordinated effort at doing this. You give us more credit than is due to us. Give us credit for collaboration and data sharing. Beyond that, nothing.
Okay, I have questions, but I'll come back later. Actually, another question where, you and the RBI may need to sort of work together. It's almost an urban legend now, ma'am, that, money from personal loans, etc., is going into the stock markets. No one knows data behind it. No one knows how true it is. Is there an attempt to collect data, and what kind of data would you be looking to collect to actually either say that, yes, this is happening, or no, this is not happening at any great scale?
So
also a question related to that. I mean, should RBI or you be concerned about personal money used in stock markets at all?
So let me answer that, because the answer is very straightforward, and then I'll come to your question, Mahalakshmi. So the answer to that question is not just in this area, also in this area, but in many other areas. Wherever there is an interconnection between the markets and the banking system or the NBFC system or the larger financial stability issue, it is a matter of normal course that SEBI and RBI exchange information. So it is part of our everyday business. It's part of our everyday business that if they are examining some matter, they may say that, do you have this data? If we have it, we pull it out and give it to them. If we don't have it, we ask for it, pull it together, and then give it to them, and the reverse as well. So in both directions, that information flow is on a continuous basis. I think that perhaps what the market is seeing for the first time is that the robustness of that data and the action taken on that data perhaps has not been seen as speedily and as quickly as has been the recent case. But this is a spirit of cooperation and collaboration between the regulators for a long time. And as I said, it's not just with one regulator, it's with multiple regulators and other enforcement agencies in the country.
But in this specific case, I think the question also is, what is the data that you're looking for to try and determine whether this is actually happening, it's happening at any scale which is therefore concerned?
See, our approach to this is very simple, and this is what we do for anything. When we have a problem, we ask ourselves a simple question: what is the hypothesis we need to test? Okay, so first you convert a problem into a hypothesis. So you paint 4 or 5 scenarios and say, maybe this modus operandi is being followed. Maybe this is the way it is happening. Maybe. So you have some 5, 6 maybes. Now you have to go and use the data to test the hypothesis that is it so or is it not so. Now, if you start with 5 hypotheses and you set out to pull out the data to test those hypotheses, 4 of them may fall. And let me tell you, that's usually the ratio. Because I encourage our team to think very laterally. कि तुमको क्या जाता है, आप सोच लीजिए ना क्या हो सकता है, then the data will show us whether or not that is the case. So 4 times out of 5, the hypothesis will fail. And let me on a lighter note tell you, there is one particular area related to the bond market, which has been worrying me for the last 4 years. Okay, and every time I say, show me the data and test this hypothesis, and the team comes back and tells me bluntly, madam, your hypothesis is wrong. The data does not support your hypothesis. And I say, okay, then I'll keep quiet. Then, 6 months later, I'll wake up. No, slice the data because it's not intuitively sitting right with me, right? From whatever my intuitive... No. But because...
What about the bond market is not sitting intuitively?
It's not sitting. But that's what I'm saying. I have no hesitation, and the beauty is my team has no hesitation. And actually, the 3rd time that I asked them, they said, madam, let it go. We've shown you 50 times your hypothesis is not held up by data. Forget it. So they tell me like this on my face, sorry, data does not support your hypothesis, go. And they go, and then they make me also go. So the question, since it's not held up by data, it would be wrong on my part. Because that means it's just...
The data or the chairperson's intuition?
No, only data. See, intuition is nothing but experience. No, but I'm saying it's the start. See, you need intuition. Otherwise, why do you need experience? Right? You can just have very young people in the whole organization. You need the intuition to ask the question. But the answer has to come always from data. It can never come from intuition.
But if I can rephrase their question now, are you investigating sources of funds into the equity market with regards to the concern around personal loan money being generated?
Every concern of every regulator, there is an attempt to test various hypotheses, and 4 out of 5 of hypotheses will fail. The 5th one, when it emerges, action gets taken. So there is nothing new or strange about it, and whatever is a matter of concern for any regulator, we assist.
How to flash this? No way to put a headline on this.
But ma'am, with regard to recent developments, and you said the continuous exchange of information with the RBI as well, with regard to NBFCs that have large capital market businesses, because there are a couple of flags that we've seen from the Reserve Bank, specific business aspects. Is there any additional layer of maybe surveillance or back testing, anything additional that right now SEBI is looking at with respect to NBFCs with large capital market businesses or capital market exposure?
See, it's not our role to look at NBFCs. The jurisdiction is very clear. What do we look at? We look at saying margin should be collected from the client, right? Including, earlier it wasn't intraday, right? On intraday positions, it was only end of day. Then we realized there's so much leverage and speculation being given, right? People were actually promoting, saying 100x leverage. I've seen those ads myself, okay? 100x leverage, come to us, we will give you, 100 rupees position for 1 rupee. So when we look at that and we say that, look, now we need to. So I think we have a very robust mechanism for saying that the margin should be collected from the investor so that we don't have a concentration risk and also investors stretching themselves beyond what they are able to afford, right? So if you're bringing the margin, as far as we are concerned, the systemic risk is addressed. Now, behind that, so we make sure that the money is coming from their bank account. Now the question is, how is money coming into their bank account is not our jurisdiction. That is the jurisdiction rights of the Reserve Bank of India to examine, and whatever data they ask from us, of course, we will share.
Not necessarily with respect to use of personal loans and that money coming to the stock market. I'm saying in general, capital market entities, which are also NBFCs but are listed in they're thriving capital market businesses, whether there's any additional surveillance right now that's going on from the point of view of their business Not necessarily the source of
Oh, that
money
way.
coming. Yeah.
No, that would be in the normal course of our inspections. So I think the difference of late has been since SEBI has adopted a lot more technology, and as I said, we've moved from physical sample-based inspections to 100% data-based inspections. So the rigor of the inspections has gone up. But otherwise, this is in the normal course. We used to examine, compliance on a line-by-line basis. Earlier, we are doing the same now. And it started with actually the mutual funds. And Navneet is back here, I see. You remember, Navneet? And again, I tell you, the industry, and it's not just the mutual fund industry. I must say now that, when I go to ISCO, which is our global forum for regulators, and we discuss some of the initiatives that various jurisdictions take, I mean, they cannot believe the level of cooperation and collaboration we get from our industry players. So I would say AMFI was always a sterling example, and now we are seeing that the Industry Standards Forum of the brokers, I tell you, the spirit of collaboration, the maturity of the institutions to say that, unless things are kosher, growth will not happen, and therefore we must ensure things are kosher. We are getting just fabulous cooperation. So, Navneet, you would remember that, when we first started data-based offsite supervision of mutual funds, so what the teams did was, and I think at that time we started with about 40, 45 algos which SEBI implemented. Then now I'm told we've either just crossed or about to cross a century. So every single granular part of the regulation is converted into an algo. The logic of the algo is transparently shared with industry. So initially, people used to say, why are you telling the industry what you're going to look for? I said, but the algo is nothing but a manifestation of the regulation. Do you hide the regulation from industry? No, you don't. So why should you hide that? Because the algo is nothing but a manifestation of saying how we interpret the regulation. So the algo logic, etc., was shared with the industry and said, look, we are going to come every quarter and examine 100% data with these following algos to see and identify whether there is any violation. Now, initially, when the algos were first set up, there used to be quite a few exceptions, I would call them. And we worked closely with industry, and there were some false positives because the algos were not perfect. Over a period of 2-3 months, we sorted out that. So all the false positives were removed, algos were modified. And today, as we speak, at the end of every quarter, every mutual fund gets an Excel sheet from SEBI. And that Excel sheet, if you open it, there are some 12 or 13 tabs. You open the first tab. Each one relates to certain sections of the regulation. You open the tab. If it is blank, means no violation. Open the next tab. If you see, these days we hardly get 3-4 maybe exceptions per mutual fund. Earlier it used to be a lot. So it will tell you that on such and such date you did such and such transaction. It was violative of such and such section by an amount of so much. Okay, and this is on 100% data. So now industry knows what are the rules. They have themselves taken proactive measures to make sure that these violations are not there, or if the violation is there, they come back and say, yes, we ourselves detected it, we have corrected it, and now, so that's fine. So this kind of mechanism which we put together for the mutual funds, and now it's a completely settled process, is working very well. We are rolling this out now across the board for most other intermediaries. So as you can see,
that's what's throwing up the bit of the black specks or the red flags.
Correct, correct. So now the question is that with the broker industry also, we've implemented quite a lot. Again, I would say very mature response and a lot of collaboration. Now as we move to, industry by industry, initially it's a bit of a shock because people, see, it's effective supervision, earlier, theek hai, SEBI aayega, once in 3 years, SEBI will show up, then they'll take some 5% sample, then there'll be an argument with the auditor on interpretation of the law, then 1 year later, the report will get crystallized, then somebody will wake up and say something. Now, every quarter, something shows up and it's non-debatable, right? So, it takes time for the industry to adjust, but it will happen.
The outcomes of the stress tests have not been made public. There seems a note or a nudge has gone from SEBI to the industry. So why not make the outcomes of the stress test public?
It will be. I think there's a date.
15th of March is when it gets public.
Yeah, yeah.
You found why you felt the need for a nudge,
Yeah, yeah.
not a clear direction.
No, disclosure. No, no, no.
And also the
Disclosure.
across other asset management like PMS and AIS, apart from this.
So, let me address one at a time. So, one is in terms of disclosure, it's not a nudge, it's a directive. Okay? Because disclosure is what we do as part of our fundamental way of operation, right? We are a disclosure-based regime. The objective is disclose so that the investor is an informed investor and can take an informed decision. So in terms of the disclosures, there is a format of a disclosure which has been approved, and that is mandatory. That's not optional for any mutual fund. They will disclose. I think the date is 15th March. So you will see that. We needed to give, a couple of weeks. So the stress testing, so let me explain. So what does stress testing mean? Okay, and what is the purpose of stress testing? The purpose of stress testing is to assess that if there is an adverse environment. So first of all, there must be stress in a stress test, otherwise what's the point? Right? So if there is an adverse environment, and how is that adverse environment defined? We have discussed with the industry as saying that if there is a significant redemption pressure, because what is the biggest risk that a mutual fund scheme runs? The biggest risk it runs is that it is a daily redemption product and the underlying market may not be that liquid, and therefore how do you deal with redemption pressure? That's the most important risk that any mutual fund scheme runs. So the assessment was that if there is an adverse environment, which means that there is a lot of redemption pressure for some reason, we don't know, it could be anything, okay, then under that circumstance, while protecting the investors, and what do we mean by protecting investors? That there should be a protection against first mover advantage, right? So it should not be that investors see and believe and understand that moving first to ask for redemption gives you an advantage. So then it just fuels the cycle of redemption, because everyone says, if I'm first in the queue, I will get a better redemption than somebody who's last in the queue. So I will be incentivized to come first. So it becomes a vicious cycle of attracting more and more redemption. So while protecting against first mover advantage, if there is a stress situation and there is a significant redemption pressure, how many days will it take for one of these schemes or each of these schemes to be able to exit from its underlying portfolio? And in that, in discussion with the industry, certain assumptions have to be made because a model has to be built. So for instance, industry submitted to us that, look, when there is stress and if prices fall, volumes actually go up. So don't look at trading volume in a particular stock in normal times, and then you'll say, so many days are required for me to exit my position. If prices fall, volumes will go up. So we analyzed the data and we saw merit in it. Although it was not always true 100%, but I would say reasonably the contention of the industry held up with the data. And so we have, in the model, baked it in, that assuming there is stress, assuming that there's redemption, assuming that prices fall, volumes could go up and could go up as much as 3x times. So we've given 3x benefit. So the whole model has been built. Now with that, how many days will the mutual fund need to exit its portfolio? So that's the stress test that will come. And along with that, the industry felt that as a single metric, it may not be the most appropriate thing for investors to only see that single metric. There are associated metrics which are relevant, which they must see, which we fully agreed and said, yes, please go ahead. So now that full format has been done, and therefore, in one place on the AMFI website, there will be a disclosure, and every mutual fund will carry on its own website the disclosure that the small and medium, small and mid-cap segments, the schemes that are there, how do these numbers stack up, so that an investor is aware that, look, if I put money into this, what could be possible situations under a stressed environment? So that is a mandatory requirement. It is not, it is a mandatory requirement. Disclosure is a mandatory requirement. What you are calling a nudge is, we believe that right now, the way that things are emerging is that there are pockets of froth. Navneet, that was the phrase you liked, you preferred, segments or sections of froth in the market. So some people call it a bubble, some may call it froth. The question is, it may not be appropriate to allow that bubble to keep building, because if it keeps building, then when it bursts, because a bubble will burst, by definition bubbles burst. So when they burst, they impact the investors adversely. That's not a good thing. So what should the industry and each of the mutual funds do proactively to not keep fueling the bubble? Now the question is that this is not something that SEBI should be mandating. And we have certainly not done any public consultation in this area. You know that we don't do any policy without public consultation. So this is not an area where we will mandate somebody to do something. What we have said is, this is an area of concern. Each mutual fund has trustees who are looking out for the interest of the investors. They should sit down and formulate a policy. Now, if each fund decides to have its own policy on how to manage this risk, we are okay with it. If the industry wants to get together and make a common policy, we are okay with it. Our objective is the trustees are responsible for protecting the investors. They should make a policy in this regard. In case we want to do anything more than that, we will not do it without suitable public consultation.
Ma'am, no directive coming in terms of capping lump sum or SIP. That's again on the industry's independence or the way they want to take it ahead. Nothing coming from SEBI on the capping.
We have not mandated it. However, we have suggested that the trustees should have a policy in place, because it sounds like a prudent thing to do to protect the investors. So they should look at it. They should formulate their own policy.
But as the outcome of the stress testing, are there any changes that SEBI is considering asking schemes to make, size or?
We will not do that before.
They accept
We will not do that without public consultation.
So now we're only at the disclosure stage. The disclosure gets
Disclosure plus each mutual fund is responsible. The trustees are responsible.
that's their responsibility. Ideally, that should be their responsibility at all points in time. But disclosure is the only additional thing that SEBI has asked.
Right now, mandatorily, yes.
Ma'am, when you say there is froth in certain sections of the market, are you referring only to small caps? Can you elaborate on that a little bit?
So, small and mid caps, we've looked at the data, we've analyzed it in conjunction with the industry. Are there some companies and segments which are being re-rated today, and that's a good thing? So yes, that is also true. But are there others where the valuation parameters seem to be off the charts and not supported, by fundamentals at all, and completely appearing to be, as regulators like to call it, irrational exuberance? So there are pockets of that. So it's not a one size fits all. It's there are pockets of re-rating, which is good. There are pockets of froth, which is not good. So that's why that's the job of the fund manager. And today, of course, we met a number of women fund managers in the industry, almost about 200, Navneet? 100 plus? 120. Pleasure it was. So that's the approach that we are taking, and it needs to be a nuanced approach, which we are assuming that the trustees will craft.
Ma'am, if I could just ask a follow-up on that, what we hear from industry is also specifically with mid-caps, because the universe is capped. There are only 150 stocks that MFs can put in their mid-cap portfolios. So is there any dialogue or consideration whether the original definition of top 100 being large cap, then 100 to 250, mid-cap, whether there's any thought towards tweaking the definitions?
So, my understanding is that there has been some discussion on this. Navneet, again, you need to remind me, I'm not completely clued in. I don't think a formal representation or a proposal has come, but I could be mistaken. But we would be open to any discussion on, on the basis of data, on the basis of, logic, rationale. So anything that is written in the regulations, human beings like you and us have sat down and written it at a point in time. If there needs to be a review, of course we should review it. So I don't think it's reached a stage where there's any concrete proposal on the table, because then I think it would have reached my table. But we would be open to that. If there is data and logic supporting something, we would be very happy to look at it.
Same question on the definition of mid-cap, small-cap funds, because the screw to label, 65% have to be invested in the same segment. Would you be considering reviewing that in view of fraud in a certain segment of the market?
Yeah, so you're very right. This question first arose when we had done liquidity risk assessment and stress testing for debt funds. And one of the issues that had come up that time is that in the credit funds, for true to label reasons, you have to put X amount in those high risk, in that high risk paper. Now you want us to do risk management, which means you have to go below that threshold. So my recollection is that we had actually made provision that reducing the stress, reducing the risk of the scheme based on, and various, I'm sure we must have put some belts and suspenders, because we don't want that it should just become, again, violate the true to label issue. But I think we had given a reasonable amount of flexibility to say if the fund manager is seeing the risk developing, he wants to reduce duration or wants to reduce credit risk, but his hands are tied, that's not a good thing. So I think we had given considerable relaxation at that time when we had done stress testing for debt funds. Now, in the same context, again, I'm not aware, but if there is any proposal, so for instance, as the various trustees of various mutual funds formulate their policies, if they come back and say that one of the things that is constraining us from holding more liquid assets is that this 65% ratio, we would be happy to consider saying, okay, let's review it, and that, is there a trigger when somebody internally to the fund decides, okay, now this is a stressed environment, or it's a building up to stress, because once the stress is built, you can't do much. It's in the build up that you can do something. If somebody says we want a relaxation of this, I'm sure we would be very open. We even have a precedent for it.
Ma'am, another question on the same topic. The premise for this data itself, the liquidity test, is based on daily average volume on the stock exchange. But
multiplied by 3.
Correct. My understanding is that especially in the mid-cap, small-cap segment, most of the transactions, I don't know what's the number, but I would like to believe that predominantly transactions are done on block basis. So to take, any reasonable small mid-cap if you take, to go through the market to unwind a position will be a Herculean task anyway. So is that a reliable way to look at liquidity, and is that the right way to look at liquidity, number one? Secondly, you said that the most important thing, risk that we should be worried for the segment is liquidity, because it's an open-ended product. To just play devil's advocate here, there's always a trade-off between return and liquidity. Would you worry today that fund managers may prefer or prioritize liquidity over the quality of the asset in terms of returns, which will play out over a long period in terms of suboptimal returns while you try to favor liquidity?
The good news in this, Malakshmi, is that we've seen this movie before and we know that it ended well. So these were exactly the same questions, and I still remember Madam Usha Thorat's words ringing in my ears, saying that, in terms of mitigating liquidity risk, you will reduce the yield in the debt funds, obviously, because if you're holding high quality liquid assets, yield will come down. And is that really what you want? And we had very robust discussions in the advisory committee. And it was at that time that, there was discussion that the redemption pressure tends to come from large investors, and retail investors pay for the volatility brought by the large investors. And is that right or not? So the whole job of a regulator is to try and balance out. See, if there were no dilemmas in life, if there were not multiple dimensions to optimize on, it would be very easy to be a regulator. So the challenge of being a regulator is how do you balance a bit of this and a bit of that and try and make it reasonable on all dimensions. So, the traditional spider's web, right? You can't allow any one dimension to pull away, either liquidity or yield. You cannot allow it to pull away. Fortunately, the expertise that the industry brings to the table. So we actually found at that time, and I still remember, we used to call it the AAA team. There was Anil, Amit, and who was the third? I'm so sorry, I'm missing the third person. So we had a AAA team from the industry. I can't tell you with what meticulousness and rigor. I mean, that stuff, that modeling was just superb. So they told us how to do this. So, the reality is we are not fund managers. We don't know how this works in the real market. So when it's co-created, so actually that whole liquidity risk management, I think finally we said you follow the AMFI model, and the AMFI actually published that whole paper in terms of what exactly has to be followed in terms of liquidity risk management. So we are very confident that the industry knows its business very well. And so long as we work together with the same objective, we will find a solution that will optimize all dimensions. It may not maximize anything. But the trade-off is there, and the beauty is that when you look at the trade-off, you know that you're also optimizing for the long term. So if you optimize only for the short run and then the investors lose faith in that product, it doesn't help anybody, right? One big blow up, okay, supposing one big blow up happens and a particular small mid-cap scheme suddenly says, I cannot redeem, and you have to wait 3 months before I can liquidate my portfolio and give you back your money. Imagine how much faith in the system can be lost. So rather than allow that to happen, the industry also understands that it's important to maintain this faith. So I'm very confident.
Follow-up question on, not on the broader issue that Madhavi pointed out, but the stress test disclosure that you've asked the industry or performance to publish. Are you expecting ordinary retail investors to understand this? Are you expecting the regulator will look at the outcomes in these disclosures and maybe tell schemes to step back when needed, or impose any other kind of directive? What are we hoping? Because how many investors are going to sit there and understand what to take away from that kind of disclosure intensity?
So, Menika, the reason there was a time many years ago, I remember, Mr. Tyagi used to ask us this question, that, is there information overload on the investor, and are they really going to be able to make sense of all of this? And I think the comfort that we have is that all of you are our channel for simplifying and explaining what is in our regulation to the investor. So whether it is on print, whether it is on television, whether it is in social media, it is the journalist community and the media that actually does that translation for us. So while the average investor may not go to the AMFI website and try and make sense of that, but each one of you will. And you will host those shows, and you will write those articles, and people will read those articles and make sense of it. And there will be people who will do comparative tables and all of that. So I know the industry is also worrying about those comparative tables being published. Let me tell you, there was a discussion that what is the need to publish all schemes on one page? Why not each mutual fund in its own website? So this kind of discussion also happens with us because, we are very open, we discuss everything. So the question is, our job is to ensure that data is there, and we have full faith in the fourth estate to say that you will translate that and make sense of it for the investor. We're not expecting them, each investor, to analyze. You will do that job.
This data will be in the form of, asset liability match. So will there be similar data not only on the portfolio side but also on the AUM concentration? So that you're
15 March is not far. Shall we move to another topic of discussion?
Ma'am, since you mentioned the fourth estate, it kind of jogged back memory of a consultation paper that was put out on finfluencers, right? Because SEBI is always batting for investor protection. So what is the thought there? Are you satisfied with the response? There was a complete de-link in that paper that was sort of advocated between regulated entities and finfluencers with master classes, with short F&O trading strategies, get rich quickly and all of that. So where are you on that now, a couple of months down the line?
There was a guideline long pending now.
I love the fact of what the expectations of the fourth estate are from SEBI. If there is something which lasts more than 2-3 months, you're saying there's a delay. Why hasn't it come? Why hasn't it come? So I think that we got a lot of feedback on that consultation paper. We had a series of meetings with various stakeholders on those issues. The one thing we understood clearly was that there are many interlinked pieces in our regulation. So investment advisor regulation, research analyst regulation, the fact that we don't have algo-related regulations, what is it the brokers are permitted to do, what is incidental advice, what is... So I think the first build... So what we realized was that this is complex and going to become very, very big, and traditional SEBI approach is not going to work. So we have to have a somewhat different approach to this whole space. The first and most critical building block for that is the performance validation agencies. Because our whole, if you see the underlying problem, okay, first let me say what is not a problem. I had addressed the Association of Investment Advisors, and I had myself said we need 1 million advisors. It is not our objective that we should suppress that. We need financial inclusion, we need savings coming into investment, so we need investment advice. We have no doubt about it. We need 1 million investment advisors. What is it that we don't want is misleading investors. And that misleading comes from claims of performance. So when you go to the root, so in SEBI we do a lot of root cause analysis so that we solve the problem at the root. Otherwise you will keep doing patchwork. You'll keep giving blood pressure medicine, but not realizing the man needs a heart bypass. So what is that heart bypass which will solve the problem and give the patient a whole new lease of life? Don't keep giving him some patchwork solution. The underlying thing is people want to claim performance. They are right in saying they want to claim performance. Otherwise, how do you attract an investor? So there must be a validation of that performance claim. So the first regulation you will see coming from us will be about performance validation agencies. So anyone who wants to claim performance, please come here, get it validated, get it done. Once that mechanism is sort of on its way, we will have a wider set of regulations related to what our regulated entities can do, cannot do, who is an influencer, who is a registered entity, etc. Also, we have another building block that we need is actually making the as I said, how do we facilitate, because we are conscious that we need 1 million investment advisors or research analysts or whatever. So how do we facilitate that as well? So I think what you're seeing now is SEBI is going to build the building blocks around this. And then you will see how the whole plan comes together. So, it's a bit like, let me give you a different example to just relate to this. So, for instance, we moved to T+1 settlement, right? And we got a lot of, I would say, kudos for it. to say this is the first major market on the globe to actually move to T+1, and many of the jurisdictions are actually facing significant challenges in doing this. Now, meanwhile, we announced T+0 and a calendar for T+0 and instantaneous settlement. So we said T+0 optional will come in March of this year. I'm told there's some talk about 1st of April. I said, "Arey, humne to March bola tha, to March, 1st of April is not March." This March, yeah. So I've only requested them to move from 1st of April, which is anyway April Fool's Day. I said, we don't want the 1st of April. Can we move it to 28th of March? So I think certainly, no, T+0. Optional. Day end. So one sec, let me just go. So T+0 will come by the end of this month, and we've already announced the calendar of option. So this is optional T+0 end of this month, and optional instantaneous in March of next year. Right? Now, one of the things which the industry, when we were having these deliberations, the industry asked us that, look, we are already well ahead of every other jurisdiction in the world with T+1. So what is the need to move to T+0 or instantaneous? Now, our answer to them was very simple, and I can only tell you that the entire room, and there must have been at least more than a dozen stakeholders in that room, instantly said, that's why. Okay, we agree with you. So what was that, that's why, was we made a simple point. We said, look, we know from where we sit in our ISCO meetings, etc., crypto is going to come. Okay? It's round the corner, many jurisdictions.
Sorry, please say that again.
No.
Crypto is going to come means what?
Crypto in the world is going to come.
It already is.
We are not sending news flash in the sound. Yes, the SEBI chair says crypto is going to come.
No.
Can we flash or not?
Crypto in the rest of the world.
In the rest of the world.
Crypto in the rest of the world is going to come. Poor Menika got a heart attack straight away.
No, I was typing something and I just suddenly
So across the world, that's why I said when we sit in ISCO meetings, we see what happens across the globe. So across the globe, crypto is a thing, and it's happening, it's on the way, it's going to come. Now the question is, we know again from, including in the G20 deliberations, etc., we know that as an asset class, this is a cross-border, it has a cross-border nature. Okay. Now, the three things which the crypto world offers to customers or investors, whatever you want to call them, the three things they offer: anonymity, which we can never offer, right? That's not a thing. A regulated market cannot have anonymity, so that's out of the question. They offer tokenization, and they offer instantaneous settlement. Whether this is actually true or not is a separate issue, but this is what they promise. Now, our logic is that we have an extremely well-regulated, risk-mitigated market, okay, where we have retail investors, foreign investors, everybody here. The liquidity is a nice, what we call a lit market, right, which means transparent. Now, if our well-regulated market cannot compete with the crypto world and cannot say, we also offer you tokenization and instantaneous settlement, over the medium term, I won't even say long term, you should expect investors to move to a space where they are now, as I said, everybody wants instant everything, right? The whole generation is about instant everything. So why should anyone believe that tomorrow, if an alternative is available with instant settlement, tokenization, and they say the regulated market doesn't offer it, you should expect people to move, right? Now, if they move and the liquidity goes away from our markets, two things will happen. One is it's certainly not good for our markets, right? I'm sure, Navneet, you won't be happy. Imagine all retail investors go running away somewhere else. Okay? Our FPIs will not be happy. So I've had detailed deliberations. I was recently in Boston and in Hong Kong, having detailed deliberations with FPIs. And I'm so glad we did that, because they had not understood this perspective. Okay? So the custodians were really articulating, operational challenges in doing this. And we said, look, this is first of all optional. And this is not something that you need to worry about. What you do need to worry about is if tomorrow, through this whole cross-border mechanism, crypto sort of comes into our country, because it can, right? Even today, if you see, there are statistics to show that even on, cryptocurrencies, etc., there are a large number of Indians who are so-called investing, right? So what do you do with that? Today also you have sites who are promoting digital options, okay, binary options. If any sizable part of the market migrates there, first of all, our market will lose liquidity, which is a terrible outcome for our mutual funds, for our FPIs, and for other retail investors who want to stay in the regulated lit market. The second thing is the commercial considerations of everyone in the ecosystem will be severely compromised. So I said in that meeting with all our stakeholders there, I said, don't worry, if you don't want to have this optional T+0, optional instantaneous, we won't push for it. Because as far as we are concerned, we see our role that since no one player can move to instantaneous, either the whole system moves or nobody moves. It's our job then to make the whole ecosystem move. If we don't do it, 2 years later, you can explain to your shareholders as to why you lost half your market share to crypto.
But crypto is not yet permitted in India, so why are Indian markets feeling this potential threat?
So I will ask you the question. Crypto is...
Can I add an addendum to that question? Are you anticipating RBI to relax its so far rigid stance?
No, I have not made any such statement, and I do not know the thinking of the regulator. What I'm saying is, today, how many Indians have Bitcoin investments? Oh yeah, for sure. But they have?
But they're watching the all-time high on the Bitcoin.
They have? How do they have? So just because, and there is even a tax on this, right? What? So the question is...
You're in the camp that if we tax it, it's...
No, I'm not in any camp. Don't read anything, Menika, which I'm not saying. What I'm saying is, it exists today. Yes? Binary options are not permitted in our country. Do they exist today? Dabba trading is not permitted in our country. Does it exist today? Yeah. So, we don't need to go very far to imagine that if something is attractive to a bunch of people, they find a way of participating in that. That's the limited point. If they find something attractive, they will find a way of getting there, because there will be people who will facilitate that path for them to get there. That's why I asked the question. Today, crypto is not permitted in our country, yet there are a large number of people who own Bitcoins. So
I'm sure this is a debate for another day when there is time to talk about this. But crypto's most attractive features,
What is that? So I'll tell you. The third thing, which we have been told, one is tokenization. So we are moving very firmly towards tokenization. So effective tokenization. I won't say the word tokenization, it has various connotations. But what does tokenization at the core mean? It means I should be able to have a small share in something big. That's what tokenization means. So why is it that we have now introduced small and medium REITs? Because I want a small share in something big. Why have we discussed with the Ministry of Corporate Affairs on fractional shares? Because I want a small part of something big. Why are we talking about making 250 rupee SIPs viable because I want a small part in something big. So we are moving very deliberately, consciously, and strategically to saying we want effective tokenization in our own market, in the regulated market, so that nobody has to go to unregulated gray zone areas to get those benefits. Similarly, if you want instantaneous, here you are, this is available to you. There's no need to go anywhere else. The regulated lit market itself is giving you an opportunity to do instantaneous. Recently, one person said to me, you're missing one important piece which the crypto market gives, which your market doesn't give, is 24/7 trading. So of course I had a good laugh at it and I said, you're absolutely right. And that matter, as everybody knows, there's still a lot of deliberation going on, whether brokers want it or not, whether investors want it or not, whether the technology can handle it or not. So that's another matter. But if there is a fourth aspect that you believe, as I said, anonymous anyway is an aspect which we will never touch. What else is the attraction? If there is a fourth or a fifth or a sixth, we would be very keen to make sure that our regulated environment is competitive and offers the same advantages to the investors and competes full on and says that this is it, that we can offer you whatever you need in a nice, well-regulated environment.
Ma'am, on going to be on the phase 1 application part only as proposed in the paper, as in only till 2:30 timing the trades will be settled on the same day. How is it going to look like? Is it the same way that the paper had proposed, the T+0?
Yeah. Now I haven't heard otherwise, so I mean I can't, you know. So yes, my understanding is that right now, basis what the feedback that we have received, I have not at least heard from my team that there is any request to shift. I don't think it was 2:30. I thought it was 1:30. 1:30. So I have not heard to the contrary that either the market is asking for less or more. I have not heard to the contrary, so I must assume that end of March. They right now told me 1st of April. I said, nahi, 1st of April, pehli to, as I said, April Fool's Day is not a good day. And in any case, we had promised the market March. So, you know, 28th March, I'm hoping they will make it available. It's anyway optional, but I'm hoping that they will. Sorry? Our board meeting is on 15th. Next March, 2025.
That is when it becomes mandatory.
No, that will also be optional.
One notification and antecedents has been published on listings at their exchanges and exchanges there. They said that SEBI is working on guidelines for the listed companies if they want to come on those exchanges also. Any timeline on that and how do we go about? What is anything that is specifically being looked at before?
Still on the kitchen table, not yet gone into the oven.
Since we had this discussion on cryptos, just any thoughts that the regulator has formulated, SEC allowing the first ever ETF crypto product? What's the thought process here within our regulatory framework?
Right now, too early for us to comment on this. I think the important statement that was made as part of G20 is that the whole nature of the concept is very much cross-border, and therefore there has to be a very cross-border approach to this. So I think we need to wait and see how that will be. The other thing which was articulated was that the fundamental principle that was articulated as part of the G20 this thing was that depending on the nature and characteristic, so if a crypto token or whatever has a characteristics of a particular kind of asset class, then it should be regulated in a similar manner. And that is very much in keeping with the ASCO principles as well, that if the nature of the instrument is similar to X or Y or Z, then the regulations and the outcomes should also be similar to X or Y or Z. So that is the guiding principle the whole world is following now, and that is something that will be the case. But as I said, for us, the strategic move to saying that why is SEBI moving towards T+0 and instantaneous is so that the well-regulated and risk-managed market continues to be competitive and it does not lose liquidity to any other grey sort of market. And therefore, all our retail investors, our institutional investors like mutual funds, and equally importantly, our foreign investors, have the comfort of knowing that all the liquidity is going to continue to be here, and it's not going to suddenly vanish because some grey market comes and takes it away.